Welcome to the latest episode of The Financial Frontier. I'm your host, Patrick Caruso. I'm very excited to introduce our guest today, Tyler Menzer, who is a PhD, a CPA, and an assistant professor of accounting at Texas Christian University, whose recent research has documented some of the accuracy issues related to the available cryptocurrency tax softwares that both the taxpayers and even in some cases the IRS is utilizing. What I want to do here today is discuss his research in detail, have him explain it in more detail, and maybe add some perspective from the practitioner point of view, and then get into, a little bit on how is this going to impact people as we start to go into this digital asset compliance era and start to see the 1099 DAs going live and everything. So, Tyler, thanks for joining us here. I'm happy to have you as a guest.
Yeah, thanks for having me and being willing to talk about this, something that I'm obviously interested in and have been looking at. So excited to be here and hopefully inform a few people about some of the pitfalls that these crypto software providers are having.
Definitely. So, this is a challenge that I've been working through at my firm now for the better part of a decade. So I was really excited to see your research paper start to shine a light on this. And, what your research shows is that you can have an identical set of cryptocurrency transaction data, and it can actually produce different results across time and across softwares, even sometimes within the same software over time. So can you maybe give us a brief overview on your approach to doing this research, what, some of the findings were, and overall what's driving some of these discrepancies for you?
Yeah, I think probably both of us kind of got into cryptocurrency, on a little bit. I think it's still kind of the frontier personally. And one of the things that cryptocurrency, especially if you've been around for the DeFi smart contract, is this idea code is law. Everything is on the blockchain. We can do it all. And I think that kind of philosophy, that idea really carried over into the tax reporting. And people saw this and said, hey, everything is on the blockchain. We can just create a simple algorithm that classifies everything and spits out a tax report. And the simple fact is everything's not actually on the blockchain. Tax law is a little bit more complicated than just what you can gather from blockchain related data. And so we end up with these situations where the software maybe doesn't know what you did or your intention as a taxpayer, or it's maybe just missing some information that's really necessary to get to the correct answer. And so I think, that's my key takeaway. Like, you can't just trust the software. Not everything is on the blockchain. You do have to add your personal kind of side of things into these transactions to get to the right tax answer. Two examples. I think I don't want to go over everything. Hopefully I wrote the paper a little bit more conversationally, so it wasn't too academic for you reading it. And if any of your listeners want to take a look, it's online. It's freely available. I should actually have a new version out coming up in the next couple months or so. But, two things that I think were useful as examples, right? Think about transactions from unconnected wallets. Right? We know as people working in cryptocurrency, right? This could be a gift. It could be an airdrop. It could be payment for services. Maybe you just didn't connect the right wallet and it's a transfer in between your wallet. Like, all of those things, right? The reason behind you receiving that money is not on the blockchain. All the service can see is that you received it. And so they have to then basically have, with no other information, classify it. Do they classify it as a gift and say, hey, you have right basis? And it would be carryover basis. How do they track that? Do they classify it as income, right? Is it payment for services? Is it, a capital gain or winnings that you got? And so they don't have any of that information. And so whatever they do by default, right, will be right for some people. It'll be wrong for some people. The other one is transfers between wallets, right? It's very common. We have a lot of DeFi exchanges. Best practices say don't hold your crypto, especially large amounts, on centralized. Use your own wallets. Keep your keys private, right? While from a tax perspective, if you just transfer crypto to your own wallet, that is generally going to be a non-event. Moving crypto from your left hand to your right hand. Well, any fees in that transaction, right? There's no gain or loss when you transfer that. but you might pay fees. There might be a gain or loss on those fees because that counts as a sale. How do you treat those actual fees, right? If it's just a transfer, it might be non-deductible for tax purposes. You get no benefit from that expense, even though you paid it. But if you're transferring from your personal wallet onto, let's say, Coinbase or Kraken to actually sell that as part of a sale transaction, right? It's multi-step. You might say, hey, those fees are actually part of my sale. And in order to sell my crypto, I had to transfer it onto the exchange. Therefore, those fees, in addition to the fees that you pay when you actually sell, are all part of the sale and should be deductible and reduce your gain. So, there's a whole bunch of these just little issues that maybe people aren't thinking about. Certainly you don't think about them when you have, stocks and bonds in a brokerage account because your broker takes care of everything.
Definitely. There's a huge responsibility on the taxpayer when it comes to their due diligence on these software platforms. Because like you said, there's two really deep issues and this is why it requires due diligence. The data quality, how these softwares are bringing the transactions down from the blockchain. Oftentimes, especially on more complex protocols, it just may be incomplete. It may be actually missing transactions. For other certain types of transactions, it could be missing pricing data or have the wrong pricing data applied to it. So you have just a data completeness issue on one side of it. And then this gets compounded further because, these transactions may be out there on the blockchain, but like your research outlines and like you just outlined here as well, there's really no context around these transactions. And there's not only is there not any context, it's not documented from a tax perspective. And that is needed for accurate categorization and defensibility for taxpayers that are going to be taking positions on their tax returns. And that's really, where the issue starts to come in, because a lot of times, like you're saying, taxpayers may be going onto these platforms and not deeply aware of all of these nuanced issues that really are in the weeds. And, if you're just going to go and plug your wallets and exchanges into one of these platforms, as your research outlines, and I encourage everyone to go take a look at it, you can be getting wildly different results. And ultimately, this variability falls onto the taxpayer to a large degree. So, crypto has given people maybe more freedom to transact in different ways, but I also think it's giving them a much higher degree of responsibility from a tax perspective as taxpayers. And, often as it is, with more freedom comes more responsibility. So even over time, I think in your research paper, you've observed the same software over time, if there's different changes to cost basis methodology or other changes that they make to the software, even those transactions over time can start to change within the same software. And that's actually another issue, even outside of the data completeness and categorization I see with taxpayers, is that they're not retaining this documentation long term. Sometimes they'll go unaware of all of these due diligence requirements, but then also leave the data just sitting in the softwares. That there can be a lot of reasons you don't want to do that from just a documentation retention standpoint. But then there's also this added issue of being able to reproduce the same calculation that you originally performed. Now, like I said earlier, this is kind of the perfect time that you came out with this research paper, because I think a lot of this is going to be coming to a head with taxpayers with the 1099 DA. So can you speak to that a little bit, and how we may start to see some of these issues that are just, embedded in the basis in these calculations of taxpayers, sometimes for the better part of a decade, may actually start to cause issues. And, something that was maybe filed 10 years ago, these are legacy assets and that basis is carrying over, it may still be an issue for taxpayers. Go.
Yeah, this is certainly one of my, I'd say, biggest concern areas about the 1099. And look, I think third-party reporting is good. It absolutely helps tax enforcement. I have other research that looks at who actually reports their crypto to the IRS, and it's not everybody, unsurprisingly, right? We were pretty sure that a lot of people are not reporting their crypto to the IRS.
Yeah, and I can speak to that at my firm. Most people were still reconstructing their cost basis and historical accounting for 5 to 10 years for new clients. So there's a wide degree of non-compliance.
Yeah. So, when you have these software updates, and I kind of see the differences in two ways, right? One, you have the differences between software providers, right? If you go to a different provider, you get a different answer. That, I mean, you can say, hey, there's uncertainty in how we should treat some of these transactions for tax. That's fine. But people are doing different things. So kind of without disclosing what they're doing, you're taking a different tax position with different providers without really being informed of what underlying assumptions do they have. I do think the problem with, data providers changing over time within the same data provider, right? You go to the same one year after year, you expect that should be the same, right? Even for the same, within the same tax year, right? It can be different. And that creates all of these issues of, okay, we have 1099 DAs. I tell people, look, enforcement is coming, right? Now, you might think current administration, very crypto friendly, although we haven't seen a ton directly about that, especially with the IRS. But you might say, hey, they're crypto friendly. I don't need to worry about this, right? And I would say the IRS statute of limitations is at least 3 years, right? So that's going to put us for these returns this year into probably 2029. If you're have significant crypto transactions, you could be hitting the 6-year statute of limitations. That's putting us 2032. I don't know what the political winds hold. I would not really bet anything that we are going to have a crypto favorable administration all the way till 2032, right? There's going to be a change in power at some point here, or at least a change in philosophy. So I don't think you can ignore it. And then, like you said, this record keeping, right? Ideally, the IRS comes and audits you and says, hey, we think your crypto transactions are this. And those numbers can be anything. You are then going to have to go back and say, okay, this is what I did. This is how I calculated my basis. It's how I calculated my sales price. And you need that to kind of defend yourself from whatever the IRS's position is. But if you don't, at least at a minimum, see what these programs are giving you, right? So you can recreate what they did. You might not be able to go back on and get it again, right? And if you say, hey, I've lost my record, but the software tells me this other thing, right? Here's this third option rather than what I did and rather than what the IRS did. But that's probably not going to hold as much water because now you're trying to recreate it, not contemporaneously. And it's even harder because, in my experience, the softwares, they tell you what the current year gain and loss is. I don't think I have seen one, and if you know, please let me know, but I don't think I've seen one that actually gives you a report that's like, here's all of the crypto that you hold, and here's the basis, and here's your carry forward for next year, your basis, right? So they're only giving you the transaction. So it's kind of up to you to figure out, okay, what lot is this coming from? What crypto did I actually sell, or is it treating me as selling? And so, you end up in this position where, the software really hate the marketing. Maybe that's just me as the real accountant. They tell you, we're going to solve everything. And they only give you half of it, right? And so, I am really worried about audit defense because I think people are going to use these softwares. They're going to think I've done everything correctly. And maybe they have. And then they're going to get audited. And the crypto software provider, if it's still around, right? A lot of these operations are actually surprisingly small because it's such a easy startup cost to just pull blockchain data and get something that looks like a tax form out, right? They might not be around in 3 or 4 years. And then where are you going to be, right? You're going to be just looking, you might hopefully have your tax return still so you can see some of the transactions you reported, but it's going to be a lot of money to comply on the back end.
Yeah, I agree with you. And I think you've raised some interesting points. That's one thing that I've been harping on with these softwares is that the majority of them are not providing tax lot level. And that, puts taxpayers at a handicap from a due diligence perspective, from a tax planning perspective, and also to a certain degree makes it more burdensome in terms of switching providers, software providers, right? Like if you did 10 years of reconciliation, platform A, and you don't have ending detailed cost basis information, if the next platform doesn't have some automated way to port all of that over, you're going to be either stuck reconciling or doing some workaround to really transfer your basis over. So that alone is a huge issue. And to a large degree, many taxpayers are not paying attention to those ending basis and not necessarily even doing due diligence around does my actual ending basis match my calculated ending basis, and simple checks like that. So it really does bring into question what are the quality of the capital gains calculations in any given year. And then you're going to start to run into, the statute of limitations that can be 3 to 6, and in some cases even beyond that in extreme cases. So they're going to run into those issues. And even outside of just any 1 year of tax reporting, for taxpayers that have long held assets who have been doing their basis calculations incorrectly in any of these given tax years, it can start to call into question future tax years where maybe you're disposing of Ethereum in a set of tax loss that you've had for the past decade, and now you're exposing of it in 2026 or 2027, and it starts to become a question of how did you arrive at this basis calculation. Then it starts to bring up this next issue of a lot of people will say when I'm speaking with taxpayers, well, this is also confusing. I'm going to just do a good faith effort. I'm going to use the tax software. I'm going to just try to report as best I can. What else can I do? And I think taxpayers are going to run into issues with that as well. And it's, something I've been warning against, because ultimately the burden of proof in a civil audit is on the taxpayer. And I'm interested to see like what your perspective is, when there starts to be more scrutiny and we start to see these discrepancies in the calculations, are taxpayers going to have an argument of good faith reliance on a crypto tax software? In their terms of service, it doesn't appear so, but like, what are your thoughts on that?
Yeah, I mean, I actually, before, as I, was kind of preparing here, I looked up, I think it was Coin Tracker, although maybe they're called Some now. I think they changed their name, right? And on their website, they're like, hey, we're doing your taxes. They're giving you the tax form, right?
Yep.
And multiple services do this.
Yep.
They give you a copy of the tax form.
Yes.
You look in their terms of service, right? And I'm reading it right now. The website does not provide accounting, financial, or tax advice. Any services should not be used as a replacement for professional accounting, right? We're not liable for any consequential loss or damage from using our service. Users of the website should not solely rely on our service, which is 180 from what the front landing page of their website says. So I think the audit, to use the technical term, and if you have to bleep this out, it's going to be a shit show, right? Because it's not done well. It is not. A lot of people don't know, and at the end of the day, it's the taxpayers that are going to feel the pain, right? It is not these tax crypto service providers. They have no liability as far as I can kind of think of, and personally, I think it's an open question what that is going to buy them in an audit. Obviously, we both know, your listeners may not know, right? You can get out of some penalties if you say, hey, yes, I reported this wrong. I admit it's wrong, IRS, but I relied on the advice of a tax preparer, a certified, licensed professional, and that can actually reduce penalties, right? The IRS will say, look, yes, you had a good faith expert. You relied on the advice of a professional. We will eliminate some of those penalties. I don't think using a crypto tax software provider gets you out of those penalties, right? It's not a license error. They're not signing the tax return. There's a question of whether they kind of should be because they're giving you tax forms, but I don't think that they are. I don't think you're going to get out of that penalty solely by using the crypto software providers. I think the basis you brought up, switching methods, to me is one of the biggest things. As far as I can tell, right, every time you log into one of these services, it kind of just pulls the blockchain data and recalculates your basis as if this is the first time you're doing it, right? For all prior years throughout all the crypto you've held. And so one issue with that is like, well, what if you switch basis methods from year to year, right? Well, you can't input it in the software and say, oh, in 2012, I did FIFO. In 2013, I did LIFO. In 2014, I did specific identification. It's just going to say, hey, you did LIFO. And I have an example in my paper, very simple. But if you change everything in the past to LIFO, right, that might not be right. I think a lot of people are going to go and just like, oh yeah, click the methods until they find the one with the lowest tax liability every year. And that's going to be switching between methods depending on what's going on. And so, yeah, I mean, I truly think it's going to be a lot of, I don't want to say bad audits, but it's going to be a lot of pain and frustration. And I think on both sides, right? I was recently talking to a reporter from Bloomberg, right? And he asked me, is this going to be really bad, right? Is the IRS going to collect a bunch of money on these audits, or are taxpayers going to, like, what's going to happen with these audits? And I tell them, like, I don't know, right? Because the IRS, I don't think, has the best information either. They certainly have contracts with some of these service providers that are probably wrong. And so I think some of these audits are going to be just kind of, I don't want to say randomly, but mistargeted, right? And you're going to have some taxpayers who get audited, and it's like, actually, we had more, right? We had more basis. We did it wrong, but we actually pay less tax. You're going to have some that we did it wrong. We actually paid too little tax. And so you're creating a lot of kind of bad effort on the IRS's part, right? A lot of costs there with these audits. You're creating a lot of stress from the taxpayer side, right? I mean, I'm worried about it from a perspective of, like, okay, somebody goes to you, Patrick, and says, hey, I don't know what this tax stuff is. I want to pay you. Let's do it right. Right. And you do it right. You go through, you recreate the whole basis, you do everything right. But that's different than the software. And it might be different than the 1099 DA, right?
Definitely.
And so then you're going to file a tax return that says, look, here's our third party reporting. Here's what the crypto vendors told me. Here's our adjustments to it.
Yep.
And is that going to create an audit risk of, like, oh, you have this big adjustment from the third party reporting, let's audit you. And so are there going to be people who just blindly follow the third party reporting, do it wrong, and don't get audited because they're matching up with what the IRS had?
Yeah. What's interesting too, if someone does blindly file the DA, especially this year, they could simultaneously just blindly claiming proceeds, but then maybe not claiming all of their non-custodial activity that's not included on the 1099 DA, which is a whole nother can of worms. But I agree with you. The audits around these are going to be interesting, but I think my biggest concern is that ultimately, in a civil case, the burden of proof's on the taxpayer, and in most cases, the IRS is using a lot of these same tools that we're discussing. Some of them have contracts with the IRS. Others are, there's RFPs and there's bids on contracts. I've been covering that for years, and I know it was in your research report as well. So, like when you think about that now, taxpayers and IRS examiners are both utilizing these softwares that we know are not, consistently accurate on just a pure data input for sure. So, when you start to get into that, what questions around procedural fairness are going to come up for taxpayers. And when, you get into this dispute process, that's where the real concern is, because on the taxpayer side, you're going to need to have bulletproof audit trails with strong methodology and context around every transaction. So, if you do want to dispute these calculations, that you have something to point to, that's defensible ultimately. But what do you think about, when we take into account how the IRS is going to approach this with the softwares, and then tell the taxpayers ultimately, well, the burden of proof's on you, what do you think about that issue?
Yeah, I mean, absolutely, it's going to be an issue. I think the IRS is getting better at it. I certainly know I have research with them. One of my other papers, we actually used IRS data to look at who's reporting with cryptocurrency. So I'm at least optimistic, right? I know for a fact, there are people at the IRS who care about getting it right. When I've talked with those people who are responsible for, like, generating the automatic notices, right? They really care about what we call that false positive rate, sending a notice to somebody who doesn't actually owe the tax. And so the IRS does think about this very, very in depth. Now, it's a new area, right? This is the first time they're having third-party reporting. Crypto tax reporting has not been very good. I think the IRS has, most of their experience, I would say, has probably been on the criminal investigation side, because they've had some huge kind of cases there. I don't think we've seen a really, really large enforcement process on just the individual normal tax side yet. I expect them to kind of go a little bit slower. I mean, I think they'll send out notices. Clearly, we have evidence from the John Doe summons that they've sent out letters, and there's
been notices on those. Yeah.
A new round of those just came out in the last year. And so I'm wondering if you probably have gotten some of those letters, the new ones. So they do. I think they've kind of been cutting their teeth on that a little bit because they have the full transaction history there. But I don't expect them to go out and send out. There's the highest estimate of 1099 DAs like 8 billion with a B, and so whatever, probably 30 million taxpayers or something. I don't expect them to send out millions upon millions of audit notices right away.
At least not right away, right? Because it would overwhelm
It would overwhelm.
agency itself. And a lot of these, there's going to be a lot of disputes. None of this is settled in these calculations. That all has to be taken into account. So I wouldn't disagree with you there.
No, I think we'll definitely see enforcement. We'll see it go slowly. And I hope, again, being an optimist here, as the IRS, and hopefully they're allowed to build up that experience and that expertise, that in a year, my most optimistic take is like, all right, we have probably a year or two of just really difficult audits, really, both teaching the IRS and learning what the IRS is doing. And then the IRS builds that expertise and it becomes more routine, right? That they have people there. Yeah, more cost based, right? We have better records. It all gets easier. And in 5 years, right, we both look back on this and be like, all right, we overblew it a little bit. I think that's the best case scenario. But, we've seen IRS funding cuts. I think, they're talking about cutting again. And yeah, if you constantly have this churn of IRS agents, it's a really narrow set of accountants who have the cryptocurrency knowledge, have the accounting knowledge, tax knowledge, and who are willing to work at the IRS.
Yes.
It's not a lot. There's not a lot of people there. And so, if we get these things, we're cutting a third of our enforcement and then we're trying to hire them back in a year. You're going to end up with people who are, kind of fresh IRS auditors, know nothing about cryptocurrency, and they're going to get, hey, this person seems, the system is spit out. They seem to be over under reporting. And it's going to be this constant churn of, not so much for me, but for you as the accountant, like, all right, we've been through this rigmarole here. We've gone through the show before. Here, we're going to teach you about how crypto works and give you the sites and give you the literature on it. But we could really see just, again, if crypto keeps going up, and the numbers just get bigger, it gets more and more profitable, I'll say, for the IRS to come and after these big accounts. And if you have big numbers on your return, that is probably going to be an audit risk, right?
Absolutely. Absolutely. And, this whole cost basis issue goes even deeper with Revenue Procedure 2024-28 that we saw. Now, I guess it's 2 years ago. Time flies. And there's even still, from what I understand, practitioner divergence on this topic in terms of the wallet by wallet accounting. So I think that's a whole nother ripple that's going to come into play with cost basis tracking. Firstly, I question how many taxpayers are actually aware of this revenue procedure, have transitioned appropriately, and are complying with all the record keeping requirements and pre lot identification and all of that. So I think that's a whole nother cost basis issue, and it kind of goes back into what you pointed out in your research paper, where to a certain degree some of these softwares almost act as like default tax advisors or default tax policy for how these crypto transactions are getting filed, because a lot of times people may just start to become aware of these things on the platform. But one thing historically that this revenue procedure clarified is, something I've spoken out against for the better part of 10 years, was on the universal basis, cherry picking HIFO and LIFO when your audit trails do not match with the softwares we're producing. And, the revenue procedure clarified that that's, not permitted going forward. But, how many people have been transacting all year thinking that they're on HIFO, possibly knowing their basis, possibly not knowing their basis, thinking they're on HIFO, and realizing maybe they have to recalculate their basis and maybe it's on a different accounting methodology. So what are some of your thoughts on that in terms of how this revenue procedure further complicates things, both on, just the cost basis tracking in general, how the practitioner divergence factors into it, and then also, how many taxpayers are going to be aware of the accounting requirements when they're making these selections in the software.
Yeah, I mean, as far as how many people are aware in general, right? None. We'll round down. It's none. But yeah, at some point we need it, right? It's one of those things where it's a painful transition. It's always going to be a painful transition because we weren't doing it right in the first place. The universal basis was always an aggressive position. Now, I don't want to say there was no support for it. You could make an argument, but it always felt a little bit weird to me that you'd be like, I have a Coinbase asset that's
Especially when you're using Haifa.
on a centralized exchange and an asset in my own wallet, and I can just interchange those. That seems weird because they are different wallets, right? And so, it's always going to be, you read through the revenue procedure, and for those who don't know, right, it says, hey, if you've done this, right, you kind of messed up in the past, we're going to give you a way kind of out of that to get you a fresh start. And, it's pretty reason. They say you have to use a reasonable method. Now, do they tell you what a reasonable method is? Not really. The examples, I don't think are super helpful when I was looking at them again, in preparation here. And so, on one hand, it's like, okay, document everything, have a reason for it, right? Try to do the best you can. And I think that's going to pull a lot of weight, right? The IRS is always very willing, if you have a contemporaneous record, says, here's what we tried to do, we gave it our best shot. That's going to pull weight, especially if you're not trying to, oh, I just happened to do it in the reasonable way that limits my gain in this year by $1 million, right? That it doesn't look like you're trying to backdate stuff. And then, we're going to get, hopefully we get some cases that, come out and say, yes, this is a reasonable method. No, this is not a reasonable method. Maybe we get a private letter ruling. There's some big enough numbers up there, although I think they're insanely expensive now. But it's years away from going to court, right? Because the IRS hasn't started auditing that. We're probably a decade away from having good case law on what's reasonable. And by that, how much does it matter? But yeah, I mean, it's going to be a big issue for anybody paying attention. And it only complicates things because, again, you go into the tax software, you have to have some way in the tax software to tell them what your basis is, right? At least at the start of this year.
And you have to know it first. So you have to
know
reconstruct, you have to make sure you're in compliance with the revenue procedure, you're using the right accounting methods.
Yeah, you have to know it. You have to know by wallet, what's your basis? You have to have the allocation. Maybe the software provider doesn't, but I haven't seen in software providers where you can enter this, right? Where you can go back. I mean, besides manually changing kind of every transaction, but at that point, you're doing your own taxes. And what are you using the software for? And so, really, I just think that, yeah, it's going to be rough. It's going to be painful for the next couple of years. And it's going to require a lot of work on the taxpayers' effort, on the taxpayer side, right?
But it's all coming down to the taxpayer.
They have to put in the effort or, pay us to put in that effort. And I don't think people really realize how much the tax compliance side of crypto is. Right. The way that I describe it is like, look, in stocks and bonds, there are a lot of crazy trading strategies you can do. In general, you and I cannot do them, right? A hedge fund can do them, right? They do high frequency trading. They can do these weird derivatives. They have the contacts and the money. We don't, right? Brokerages restrict, right? It's getting more and more able, but we've slowly built up the reporting infrastructure for stocks and traditional investments over decades, right? Crypto basically just came and said, hey, the craziest strategy you can think of, you can do it. And anyone can do it. And anyone can do it with $10, right? If you're trading $1 million, the tax compliance, right, on that, fine, whatever. A few tenths of a basis point.
Yeah.
If you're trading $10 and you're going to have to pay a CPA $100 to figure out what your basis is on that transaction, you're not making any money, right? It's going to eat into those very small margins very quickly. And I've had people tell me, they're like, one person I talked to, back kind of when DeFi yield farming was much bigger. He was like, look, I can enter into these DeFi contracts. I can yield farm, by going through 5 or 6 different platforms. And I'm fairly certain I can make a decent amount of money. I don't do it because of the tax compliance. right? Because the tax compliance gets insane and you
Very,
quickly eat away at any margin
yeah.
that you have.
And the problem is, what I've seen is that many tax, obviously the people, that built a lot of these products were not building with tax and accounting in mind. And the people transacting weren't transacting with that in mind either. And many of them are now sitting on, legacy accounting debt for 5 to 10 years. And then they go and they try to plug it into one of these softwares and they're met with, all of the data issues, all of the missing context, all of the questions around the tax treatment and categorization. And there's really no good way to solve it ultimately, and it's extremely complex and it's very costly, and I think that really lends to the overall non-compliance for a lot of taxpayers that are stuck in this position where some of them can have dozens or hundreds of wallets, tens of thousands, sometimes millions of transactions, and it is no small task to properly reconcile that in a way that is defensible with the IRS. And despite what any software may tell you, you're not going to be doing that in 10 minutes or a day or, whatever the claims may be. It's going to forensic level reconciliation. If you're transacting across, many complex protocols, you're going to be tracking and tracing these transactions through the blockchain. So it's going to be a big burden on taxpayers. And ultimately, I think taxpayers that are holding substantial amounts of crypto that are these legacy assets held in this phase that existed before this third party reporting in this predeterminism phase, they're the ones that are the most at risk because these basis issues have just gotten more complicated with each year. And if you're still holding these assets, it's not going away. When you dispose of them, your whole audit trail can get called into question. And, that's really where the rubber meets the road with a lot of this. Another whole interesting issue is because, I agree with you. Hopefully, the cost basis starts to get worked into the system and we start to see some simplification as this rolls forward. Probably will be slow. But, one other thing that we saw back in 24 and 25 was the repeal of DeFi out of the definition of a broker. And this really, not hitting that side of the market and all of these transactions. What's your perspective on that? And how durable do you think that this current landscape is as we move into, new political dynamics over the next like 5 to 10 years, let's say?
Yeah. Look, call myself, the most pessimistic crypto optimist, but there were issues with the DeFi regs. Without a doubt, I don't think anybody disagrees with that because it's a hard area. My personal view is, look, I'm sorry, Uniswap could go hire an accountant and send out reports, right? If you are a DAO, you are large enough, they have enough money, right? People are making money from running Uniswap. They could do it. There's no reason not to treat them as a corporation. They are not truly decentralized in the way that crypto maximalists would hope, right? Or want. There just isn't that level of decentralization. I've looked into the DAO stuff and, it's not what people hoped it was going to be. So I think eventually we're going to have to get to a point where, they say, yeah, you might be decentralized, but you know what? So is Disney. So is Walmart, right? All of these companies have very diversified ownership, right? Among millions of people, and they hire a manager. They hire somebody to do their taxes. But there were issues with DeFi. I don't think it would have been beneficial for those regs to go into effect for this year. Probably would have caused more pain than they're already going to cause, right? And more pain than not having them. And so, I expect there's going to be something. There's going to have to be something if DeFi does not go away, right? And I don't think it's going to go away. I don't think the US is just going to sit on the sidelines and let it be the way to avoid taxes on your crypto.
Yeah. And especially when you look at global trends too, and where it seems like this is going to get bought into the definition one way or another. What you're alluding to, I think some sort of tiered approach may be more effective, based off of the size of the company and the amount of users and, finding some sort of middle ground and some way to roll this out where it can be effective and not really compounding tax issues, like you said. So I'm really interested to see where that is how this develops going forward, because during the proposed regs and the finalized regs, I mean, this was a highly debated topic. There was tons of industry pushback, and some of it valid. I think there's a deeper issue that the industry has, where there's this kind of divide between the industry that wants to maximize privacy and regulators that just want compliance. They want accurate tax reporting, and to a certain degree, that means having some identity around any transaction that's taking place. So there's going to have to be some sort of meeting in the middle, I would think, in the future. Would you agree with that? Between the industry that just kind of says, no, we're not going to KYC anything. We don't want anyone having visibility into our transactions, versus compliance coming on chain.
Yeah, I mean, it has been really interesting to watch how crypto has kind of gone through its, I'll say, growing up stage, right? Because, back in 2016, 2017, before then, like, yeah, we're just not gonna comply with the law. We don't care, and you can't catch us. And that worked for a while. I think in the last kind of cycle, maybe the year before that, kind of since FTX blew up, right? We've obviously seen the US players get bigger and bigger. I don't know, I'm sure Molly White, who writes a lot on crypto. She tracks crypto political donations. Huge amounts of money went into politics the last cycle. And
Bitcoin conference was like partially a political conference.
Yeah,
That years ago.
It is crazy. I am very interested to see if they can maintain kind of a bipartisan, at least appearance, because I think it's kind of been moving away from that a little bit. We still have, kind of the two Democratic senators who are very pro crypto, but I think they have to kind of change their strategy a little bit. I think one thing that we see just in industries in general, right? And the example I give to my class is Amazon on sales tax compliance.
Yes.
Right? For those who are not old enough to remember, there was a time, right, where Amazon did not have to collect sales tax on purchases from states where they did not have a presence in. And for a long time, Amazon vehemently fought and lobbied states should not be allowed to collect that sales tax. Eventually, Amazon got big enough. Eventually, they were in every state. So they were collecting sales tax anyway. Well, that switch flipped, right? Amazon then starts lobbying. Well, everybody should have to collect sales tax because we already do it. So it's a cost on all of our competitors because they're not the ones, right? And so I think we're going to see a similar thing in the crypto industry where, right, Coinbase, Kraken, Binance, they're too big for regulators to ignore. They're centralized. They're going to have to do this tracking. And at some point, they're going to realize, hey, we're losing volume to these decentralized exchanges, especially if people are using them as a tax avoidance tool to not report, right? And they're going to say, hey, we're the ones donating all this money to you regulators. Let's make it a fair playing ground. Let's make it a level playing ground. Let's have everybody report. And obviously it will be to their advantage because they're already doing it. They're going to make others do it. And so, I'm interested to see where it goes. Personally, I would say, and any of your listeners, if you're going to call your legislator, your congressman, your senator on one tax issue, I will, fight for my pet issue on crypto, what I think is truly the most important issue, and that is getting mark to market for cryptocurrency traders.
Yeah.
Right? Because I think mark to market, it's a win-win for the IRS because it will generate more tax revenue. But for individuals, right, the best thing you could do is be able to just say, hey, I mark to market. I treat everything as sold at the end of the year, coming into the new year. I know exactly what my basis is in every asset because I just treated it as sold, right? It all gets stepped up or stepped down and we're off to the races, And if you're trading high frequency, you're probably doing all short-term transactions anyway. You don't have a ton of big gains. And you
simplify things with on, especially like you said, for people with, really simplify things for them. And I agree with you as well that, in some form, we're going to see taxes get bought into the purview here in the future. I've even been seeing, some talks of, people anticipating the 1099 DAs and saying, if you're going to transact on chain only in stables and only only send the stables, to the exchange. So, like you said, if this is starts to be how this is looked at, that this is where tax evasion or tax avoidance is happening on chain. Eventually, we're going to start to see some definition, even if it's materially different from the original one that got repealed, which it would have to be, but it's going to likely take some form. It's interesting you bring up sales taxes too. I don't think it's a huge issue right now, but as we start to see, or if we start to see more commerce come on chain, I started to see this be an overlooked issue during the big NFT craze, because those NFTs in some states like Washington and others have sales tax exposure, depending on the type of NFT and the underlying nature of them and all that. So on chains, if on chain commerce really takes off, you could have a Wayfair 3.0 potentially on on chain transactions. There's no tooling or ways for companies to comply with that right now if they have to either. So I think that's really interesting. So yeah, this is going to be a very interesting year, Tyler. So I would love to have you back on here in the future as we start to see, how tax season plays out and how enforcement starts to play out over the year, and what's going to happen with taxpayers and these softwares. I think there's going to be a lot to discuss, because we really are entering this new era. I call it the digital asset compliance era, where now there's going to be third party reporting, and it's really this new phase kind of that you were alluding to a bit, where we kind of had this cypherpunk mentality that started crypto, and a lot of that mentality is kind of getting washed over by this new wave of regulations and institutions coming in. And I think a lot of these people that are holding these legacy assets from this prior era, this predeterminism era, are at the most risk, because it's not going away like you may have thought for all of these years, and this cost basis is going to follow you in the future. Ultimately, if you want to protect your assets, it's not going to be any small task, as I'm sure this discussion has hopefully helped illuminate for some people here. So again, this has been a great conversation. If someone wants to read your research paper or get into contact with you to speak with you further on this topic or any other topic, because I know you're doing a lot of interesting research, what is the best way for them to get in contact?
Yeah, I'm assuming you could probably put my contact information in the show notes or whatever. But obviously, you can find me on TC's webpage if you just search for my name. I have a personal website with all my links there. My research is all on SSRN, free to download. Anybody can go on and download. I'm also probably a little bit too active on Twitter. If you want to, see some really hot takes on crypto and taxes in general and economics. But I'm happy to, if anybody wants to reach out, if anybody wants to talk. Obviously, I don't practice really too much anymore, besides for my own stuff and a little bit of consulting. But I'm always happy to talk with people. Always happy to give my opinion and to listen to people. So yeah, feel free, reach out to me anyway. My contact information is hopefully pretty easy to find.
Definitely.
But definitely have them reach out. More than happy to chat with people.
Absolutely. Well, I encourage everyone to follow your LinkedIn. You put out great content there, and your Twitter as well. I'm going to have to personally follow you on Twitter for some of those hot takes, because I know we're connected on LinkedIn, but I don't think on Twitter. So, Tyler, I appreciate it. Very interesting conversation, and this is a problem that is going to not go away anytime soon. It seems to only be compounding. So I'm sure we'll be speaking again here shortly. So to everybody listening, I hope you took some value from this conversation, and I appreciate you taking the time to listen. Thank you again to Tyler for being our guest today. Until next time, I'm Patrick Camusa, signing off.